So I think at the end of the day, is tech winter here? Yes. Is it going to happen again? Yes, because it's happened before. And is it good or bad? And it says, well, it depends on whether you're a grasshopper or an ant.
We're talking about how you do math.
Yeah, well, long story short, we met because we were students studying at Orchard Library. And I was in NS studying for my SATs. And I think that, I can't remember what you were doing.
Studying for O-levels.
Yeah. Right. Okay.
So,
Geraldine just randomly met at the library.
Yeah, so we met at the library.
And became friends after that.
Correct.
Kept in touch with each other, and both are now in the tech industry, right?
Yeah.
Yeah, time flies. Since
Well,
I was like, oh, I don't know how to do math, and now I'm like, oh.
and now running businesses, helping people run businesses.
Hopefully I know math better now.
Hopefully, oh, you should.
I should.
As a
That's
VC.
That's what you think.
Yeah. Because actually VCs might just be good at picking companies, right? You need not do the actual math yourself.
We have to do math.
You have to do some
but
math,
this is
right?
a math, yeah.
Okay, valuations and all that.
Yeah, exactly.
Jeremy has been on the show relatively recently, so you can check out his episode, Should You Invest in Your Friends and Family's Businesses? Well, both are repeat guests, right? And in between now and the last time Geraldine was on the show, you changed jobs.
Yes, I changed jobs.
Tell us about that.
So previously when I was here, I was still at Salesforce. Wait, no. I was in
Change jobs again. Moving up.
I was at Workado. So right now I'm doing something different.
Right.
So I'm looking after the commercial business at an Israeli tech startup called Spot. So we recently acquired by an American MNC. Basically, what we do is that we help customers with cloud optimization.
Yeah, okay. You don't want to sell to me, right? Just okay, I
So
have
we
enough
can
information.
download the materials at bit.ly/123.
No, which is actually very relevant during this time, right? Because a lot of companies are actually thinking about like how can we improve our unit economics? How can we grow faster? How can we be more productive? And basically what Spot does is really optimizing and also automating the infrastructure management, which fits exactly into all these three objectives.
Right, we need your perspective because we're going to talk about the tech industry today.
Yeah.
And well, if you've seen Geraldine's IG stories, right, she's been talking about a tech winter. So I want to ask both of you, is a tech winter coming? And a bit of background about that, right? Because, well, first of all, how would you define a tech winter? Geraldine, why don't you take it first?
I guess when we look, everybody's talking about tech winter these days, right? And if we look at last year, all these companies, they were basically like hiring like crazy, right? Spending a lot, going on boat parties and all that. But right now this year, the approach seems to be more conservative. So what does this mean? It means that they are really more focused on like unit economics. So when we look at the news, we will see companies
Help us understand unit economics. Yeah.
spending prudently and being more efficient in the way they operate the company.
Okay.
So if we look at the news, we will see stories of like layoffs. I think it's every week I get like a story of like some company, be it big tech or like startups, talking about like how employees are being let go and everything and how they really need to double down and focus. And for those who are not laying off yet or not laying off, they're basically issuing press releases about how they are going to be profitable soon. So there's this whole talk about pathway to profitability, stretching your dollar, becoming more sustainable and all that. There's the whole shift and focus. And last year, I think Jeremy and I were having this conversation, right? I asked him, what do you care about? He said, growth. I only care about growth. But like this year, suddenly like you get like, do you remember that?
Yeah.
Yeah. And then this year, like there's a lot of more focus on like,
Profitable,
sustainable,
right.
profitable and everything. Yeah.
Okay, so do you think a tech winter is coming?
I think the thing about winter is that it comes by every year, right? Because it's part of the seasons.
Seasonal.
And I think what we mean by that is this is not the first tech winter that has happened before, right? I mean, we heard of the dot-com boom. We actually had quite a lot of dynamics that happened, and we see that in China and tech as well. That was happening over the past few years. So I think the question is just like, there's always boom and there's bust cycles in every vertical, right? We see that in oil and gas, we see that in commodities. And the truth is that we see that in technology as well. And part of it is actually really linked to not just, of course, technology, but also I think fundamentally, how much do we as a society value technology and the promise of future profits down the road versus, other investment opportunities? And that's actually very linked to interest rates that's across the world.
Yep.
And so, for those who are in the know, I think we've been in an environment of low interest rates for a good chunk of time. I mean, the US Fed printed so much money over the past few years versus what they have historically printed. I mean, to put it in context, over 100 years, they printed about $1 trillion of capital. And then over the past 10 years, they effectively printed 6 trillion, right? So this kind of think about it is like, you deliver 6x the amount of print, but then you do that also in like a fraction of the time as well. And so all of that generated obviously a lot of asset inflation across the world, but it also created very low interest rates. And what low interest rates mean is that a lot of the projects and products that provide some level of return are fundamentally no longer attractive because of low interest rates. But then something like technology, where you have a future return, and as a result, normally subject to a lot of discounting rate versus that interest rate, fundamentally, it becomes much more compelling. I think the low interest environment made technology be very, very compelling. And so a lot of capital went there seeking for a high return. In a low interest rate environment or negative interest rate environment. Basically, there was a huge shift that happened with the recent inflation spike due to the global crisis, obviously in the Europe, in energy, and so forth, the unwinding of the China-US trade relationship, deglobalization. And so all those things basically means interest rates are going up to control that. Investment opportunities are more compelling now versus technology. And so capital is being pulled out of the system. That would be great, because I make it sound very financial, which I think is for the audience here. But I think where the pain really creeps in is basically what happens when companies that were built for summer, the story of the ants and the grasshoppers, right? The grasshopper plays all day during summer and then freezes and dies in winter, but the ant that was working very hard in summer survives the winter. And I think there's this dynamic where a lot of grasshopper startups that unfortunately were kind of overbuilt for assuming a high capital liquidity environment, unfortunately, are now going through some tough decisions about doing layoffs and restructuring themselves. Whereas, I think some founders who saw this coming or were more conservative, and I've met a lot of them, are not only doing well, but going to do better during this downturn. So I think at the end of the day, is tech winter here? Yes. Is it going to happen again? Yes, because it's happened before. And is it good or bad? And I say, well, it depends on whether you're a grasshopper or an ant.
Okay, yeah. I mean, you mentioned low interest rates. Those were good times. And Jeraldine also pointed out, now companies are more focused on sustainability. So do you think there's a shift from profitability? Last time it was growth, and now it's shifting towards profitability, actually making money. Are VCs being more prudent in where they invest? Well, the background of this is that last time you look at growth, right? Jeraldine saying that you only look at growth. The classic example that we all can relate to will be Uber, and they're losing money per trip back then, right? To acquire customers, capture the market, conquer the market, whatever you call it. And that's okay because growth was the main focus back then. But now are we looking more at, are you making money or not?
The reality is VCs are still looking for growth because what that means is if you look at all the different categories, you can put money in stocks, you can put it in cash, you can put it in bonds, you can put it in real estate. And I think the mandate for venture capital is still to invest in technology that's growing very fast. The question is, how fast is that growth, right? And I think that when there was a low interest rate and there was a lot of liquidity in the venture capital markets, there was this big assumption that there will be more capital for a company to figure out growth a lot and then be able to count on other VC capital to come in to support them when they become profitable later as well. And I think what's happened is that bar or threshold is, you still need to grow quickly, and you should also have demonstrated that your unit economics at a fundamental level are working. And the truth is, I think all of the sober VCs who have seen this story play out, honestly, over the past 2 decades, they still remember the dot-com crash and all these other things. So I think we've always still been there. We've always been looking for high growth and strong unit economics. However, I think there were a lot of venture capitalists, unfortunately, who were also part of the party, and they were willing to bid up and invest in companies that showed that high growth or even higher growth without any evidence of that unit economics. And so the combination of these two groups of capital has created this tech boom that we've seen over the years. But now I think, parties starting to wind down, and so people are sobering up. And I think there's that reversion where newer investors are starting to say, they're kind of relearning what we already relearned multiple times in the tech winters that we've seen around the world, which is that the time horizon for a startup is at least 10 years, maybe even 15 years these days. There's definitely going to be a bust cycle within those 10 to 15 years. And I think people forget that all the time. It's a long time to build a company, and the super cycles are between 7 to every 10 years. There's always going to be a recession, and there's always going to be a boom cycle. So how do you have that equanimity as a founder, and how do you have the equanimity as a board member, and how do you have that equanimity as a VC to be disciplined during good times and to be aggressive during bad times, right? And that's the story of the ant, right? Which is, you can be aggressive during winter because you start up during summer, right? And I think that's really that whole life cycle that I think everybody has to be thoughtful about.
Geraldine, of the companies you've worked at or worked for, like, do you have examples of them being ants? Like, how did they prepare during summer to prepare for winter?
Well, so I speak with many different companies out there. I think that it's really more about being responsive to change as well, right? So in one of the companies that I spoke with, I think it was as early as in February, they already sent out like they already presented in their all hands like, hey, interest rates are increasing. It's going to be harder to raise our next round. What we need to do now is be more, double down on growing, but at the same time be more focused on like saving costs. So some of the things that I've seen in the recent months would be like, cutting down travel expenses. So I think for many companies, if you work in tech, you can basically fly SIA everywhere. But now it's like, please take Scoot if it's, nearby, right? And all that. Also, like other things that I'm seeing will be like, encouraging people to prudent about like all the other like parties and stuff like that they they often organize, right, during the good times, the summer times. Yeah,
they're quick to react. I'm also reading reports about companies freezing hiring, or in the US, I'm reading reports about getting those work from home employees to come back to the office, and if you don't, please do what you will, which is to leave the company, right? It's kind of a natural attrition going on there. So when you talk about winter, we give the macro picture and we give some numbers. You mentioned like this. Okay, of course, finances is good for our audience, but on the ground, if employment looks bad, then that's something to worry about. But interestingly, because if I look at reports, right, let's take Singapore for example, because I just saw this yesterday. Q2 employment, at least generally, employment is going back to near pre-pandemic levels. And of course, in the US, whenever you talk about the recession, they're always bringing out this counterpoint of, but employment data looks good. And of course, this is looking at employment data generally. And of course, this is looking at old data, looking backwards, right? So looking forward, you're saying that there is a winter. We should definitely be prepared for it. And that employment data might be bad. There might be layoffs coming. Right, do you see that, Geraldine?
Basically, your question is really more about like, do I see employment like dropping?
Specifically looking at employment, because we talk a bit about profitability, but let's look at the employment.
So I cannot speak for the other industries because I do not.
We're looking at tech specifically for this session. Yeah.
So if companies are not able to raise their next round, and then if they are not being like prudent about expenses and they are not growing as fast as they want, definitely we will see employees from these companies being laid off, or maybe having their salary cuts and things like that. Yeah.
How are they managing profitability and all these layoffs? Like, what kind of jobs are being lost right now?
I cannot say for sure what is the main type of job
what
that
you're
is being
seeing.
lost, but what I'm observing is mainly recruitment jobs.
Oh,
yeah, because last year there were a lot of like tech recruiters being hired, right, to snatch and fight for tech talent. But one of the jobs that I see being impacted is actually recruiters, because if the company is not like hiring aggressively anymore, what is the reason for having some of these recruiters, right? So that's why a lot of them are being let go. Other roles that I see impacted generally, I mean, I'm saying generally because every company is different, right? Is the ones that are not connected to revenue or product. Yeah, these are the two areas being seen.
Is that what you see, Jeremy?
I think that's really spot on, because exactly like if you were built for high growth in terms of revenue, and therefore you said to yourself, I need to have a high headcount growth, then when you decelerate, I think less recruiters is one. And I think the other way to think about it is that, if you put yourself in the seat of the executive team, right, you're looking to strengthen your unit economics, your revenue model. So that means it's important for you to keep your top performing sales reps, your marketers who are quantitative or able to prove that they are cost effective. Channels are really important. And obviously product, because you're still looking to get out of your product debt, or your coming out of your engineering debt, or you have to build new features to sell new customers. So I think really spot on there. What that means then is, from an individual perspective, is are you material to the company, right? You know, at a deep level, like, am I nice to have or am I, you know, a must have from that new environment? I think people have to be very thoughtful about their job scope. And if that means that you're in finance or you're in other parts of the company, I think the challenge is how do you make sure that you continue to articulate to your manager, your supervisor, leadership team about why your role is important, but also you continuing to evolve your role to be more focused on that. So, for example, you're in a finance team, can you kind of like raise your hand and say, hey, I'm willing to be part of the cost cutting or, you know, like, you know, workforce to proactively work on that, for example. Or, you know, if you're in recruitment, then kind of like say like, hey, how can we proactively put together a budget that's much more conservative, right? But also allow us to, you know, keep our headcount. You know, we will, you know, we in-house some of those functions and use less consultants outside. So we preserve our jobs in that sense. But then, you know, we let go of the, you know, consultants that were previously helping us with that function as well.
So I should be asking myself, am I directly contributing to the bottom line of the company?
Yeah, or how can I improve my scope so that I'm part of that? Yeah,
right. And of course, you can argue that every job has its function, but you know, when push comes to shove and companies are forced to like, you know, cut on costs, you know, it could be let go.
Yeah.
Actually, on that, Jeremy, while you're actually talking, I have a question. Can I ask questions?
Ask Jeremy, right?
Yeah. So like for most of the you know, attrition and all layoffs and everything, I see that happening to tech companies.
Yeah.
But I'm not sure. Are they happening also in the VC side? And the reason why I ask this question is because on one hand, you have a lot of like what we call dry powder, like in Southeast Asia now. I think many people set up their own like Southeast Asian funds. You know, talk about Insignia, AC, Sequoia, a lot of like money that is coming into this region. But at the same time, like investments are taking longer, and then there's less volume also of investments, right? So, what is your take on it? Do you think that, you know, VCs will be impacted also?
For the thousands of people in the region who may be exploring a venture capital job, not the millions.
Yeah, because I asked him, how does one become a VC? And the first answer he gave me, I'll rephrase, basically have a lot of money. That's number one.
That's the easiest way to be
Yeah,
a
you
VC.
can be a complete idiot, but as long as you have money, yeah, people are going to come to you. But of course, the next answer he gave was, well, you can start working for a VC firm, start learning experience, there are courses you can take up.
Yeah.
So, okay.
Yeah. I mean, I think the reality is that, again, venture capital is a marathon, right? Not a sprint. And so the capital cycle is over, like, you know, every fund is like basically a decade, right? You know, generally the teams at the senior and middle level are relatively stable because, you know, they have that understanding that it's such a long journey. And I think some of the shift maybe would be on the junior level, would be like, yeah, are there as many openings there are for entry level venture capital analysts to join the team? The answer is probably less. And the reason why is because I think existing funds will continue to be, you know, moderate and thoughtful about their deal flow activity and efficiencies and so forth, which is not a problem. And I think that new funds that were thinking they're going to raise a lot of capital or that were able to deploy, but unfortunately were caught out and are underperforming versus their requirements, will have less jobs as a result. So I think it's not really an issue at the middle and senior levels, but I think at the junior levels, there will be less openings than they were a year ago.
Okay, so we got to position ourselves, right? So Jeraldine, what are you doing to position yourself in this environment?
So from an employee's perspective,
Yeah.
I mean, this is a finance podcast, so basics apply, right? Have an emergency fund.
Okay.
Right? And then when you're thinking about making big purchases, for example, property, it's good to be more conservative and think from the perspective of like, hey, what happens if 6 months' time I don't have my job and I'm going to be unemployed for maybe 6 months? So can I actually fund my mortgage and all? So these are hard questions to really ask yourself on an individual level. And I think that this is also the best time to actually grow. Because if you don't stay competitive, you don't improve yourself, you don't keep up with the trends and, you know, upskill yourself, right? Then it's really, you're putting yourself at a risk of being, you know, left behind. And yeah, so these are the two things that I'm actually doing, really just being conservative about expenses and at the same time also doubling down on my own learning. A third aspect people don't think about, but I think should be given more attention to, is actually networking, because that will actually serve as a safety net for yourself, right? If in an instance you get let go or something. Because what I'm seeing right now is that, I'm in various like tech WhatsApp groups, right? And then people are like sending like Google documents or Google Sheets about like, hey, these are all the impacted people, let's help them, and then like coming together to support each other. So immersing yourself in this kind of communities, getting to know more people, that's absolutely critical as well.
Of course, learning and improving yourself as an employee, right? Your skill set and everything. So, Jeremy, as a VC, do have advice for startup founders when they do recruitment? Like, what kind of employees should they be looking out for? And I'm asking this question so that those who want to prepare themselves for tech winter, make themselves more valuable as employees, right? They can know, how can they improve in becoming a better employee.
I think when it comes to recruitment, I think everybody knows the basics, right? Which is, you want someone who's able to perform the job description and do it well and then work well with the team. What I found is that it's less about the criteria and more about the standards that you hold yourself and the recruitment team as a whole. What we mean by that is that there often may be a case where this person is good enough, right? And the question is that good enough, right, as a team to buy this person? Because that's something that would have been easier to swing for during the good times. But during these tougher times, I think the threshold is higher to be like, yes, this person is definitely going to knock it out of the park, right? Which is a higher threshold. And so founders and executive teams and hiring managers should really hold themselves to a higher bar. And if they're unable to come to that conclusion, really consider how they can test for it deeper, right? So could they use a case study? Could they provide an opportunity to work on site for a week, all right? Have a probation period for 3 months. These are things that were tougher, frankly, to implement during pro-employee time period, during the tech, kind of like summer. But during the tech winter, I think that for the right talent, it would really let you and the team get much better conviction to be like, okay, this person is definitely knocking it off the park. And I think that lets everybody be happier, right? Which is, I think the employee knows that they have a better chance, better future at the company. The company feels that they have a stronger foundation for their unit economics and therefore their overall revenue and profitability goals. So I think at the end of the day, a job is always a mutual match, right, between two sides. Is this a good company for the employee, and is it a good employee for the company, right? And I think that's something that now has a higher threshold for everybody.
So it could be that if you are a B player, that used to be relatively okay. You're safe generally, but now it could not be that safe anymore if you are not, really one of the A players within the company.
Yeah, I mean, I think that in the past there was this thing which is like, let's definitely hire A players, and if we hire a B player, let's give this person a shot, or let's hopefully coach them to get to an A player.
Right.
And I think that's not the best mindset. I think I normally share with people is like, you want people who are A players or could be A players. And I think there's a bit of a fine distinction, which is saying this person's a B player versus someone who could be an A player. But those are actually very different dynamics, right? Which is, do you see the coachability? Do you see the humility? Do you see the self-awareness that lets them have that future, right? And I think that's the difference between those two categories.
Geraldine, you want to react to that?
When Jeremy was, describing all this, right, what I was thinking about is that actually for companies, startups, it's actually a great time to actually hire. So last year you have, a lot of competition for good candidates, right? But this year there is less competition, right? Because sometimes good candidates may, as a result of companies' decision, be released back into the job market and everything. So it's a good time for companies to hire, and you can actually pick up some of this like talent you might not have access to like the previous year as well.
Yeah. So how do you think this tech winter will play out? And I know we're playing prediction games here, right? but let's talk about how long do you think it will last? What are the factors? What are the variables that will cause it to shift and all that? Let's try to, how far do you see this? Q4, Q1? How will this tech winter play out? I'll ask Geraldine too. Jeremy, go for it.
Fundamentally, a big part of it, again, goes back to interest rates, which is linked to inflation. So as long as the Fed is increasing interest rates or keeping interest rates high, the awkward reality is that putting money in your savings account is better than, so on and so forth. The hurdle rate is higher for VC and any kind of project. And so to some extent, we're actually making macroeconomic predictions or forecasts, right?
Do we believe
do we believe what the Fed is doing, but also do we believe that the factors that are driving global inflation, when is that going to play out, right? And I think the truth is, in the short term, I think energy and the Europe crisis, unfortunately, is going to play out at least till the end of the year before there's any resolution. And so I think energy would be a problem in terms of inflation. I think that the unwinding between deglobalization and the fragmentation of supply chains is a more serious concern in the medium term. And so, I would say, this period of high interest rates will last at least till Q1 next year. And so as a result, I don't see any shift, I think, from a technology perspective, in the sense that I think there'll be a deepening of this tech winter at least till Q1 at minimum. How long it will take to recover, again, will also depend. That being said, the joy of technology is that, there's so much creative destruction, and there's so much renewal all the time. And I think in the harshest of these winters, I think there will be still great founders, and I've met them, who are still crushing it, still growing, still being thoughtful about business. And I think they will still be able to raise large venture capital rounds in Q1 next year, for example. If you weren't prepared for the winter, you can't count on winter going away. But for those that have been able to build, I think there will be good stories in Q1. And so I think there'll be a lot of stories in Q1 to be like, is tech winter over, right? Because all these people raise lots of money. And you're like, yeah, because, it's like green shoots, right? Like the seeds and spring is coming and spring is here. And, it's still cold, AF during spring. But, I think the best teams will still be pushing forward.
To add on to that, right? What I see, like the boom times was actually like, rising tide lifts all boats, right? So it's very hard to separate the good and great and not good companies. But what is happening now is that we're starting to see like, hey, who are the actual winners, right? Who are the people who are really like performing well and running this business well, who can execute versus like those who can't and we're just like cowboying their way through. So to address that part about like how long I think this will last, so I don't have a I'm not very good in making like forecasts, I guess. But what I've seen is that on average, like what we call like down cycles will last about 15 months. So this is statistics. And what I've been hearing from VCs who have been posting on Twitter is that they're telling founders to prepare for like 2 years or even like 3 years runway, right? So I guess that this is probably like how long it might last.
It's like they're saying winter could be longer than you imagine, right?
Yeah.
Right. So I want to ask questions for those who are interested in investing in tech. So what do you think? Is it a good time to invest in tech stocks, or wait and see, wait till we get more clarity on the inflation and interest rates environment? Jeremy?
It's a good time to invest in early stage tech. Okay. So private markets, because all the founders who now are being asked to raise 2 to 3 years, they are willing to, I think, be thoughtful about the price, about what's a fair price versus the experiments and milestones that haven't been de-risked in their growth journey to become, an exit and be a unicorn. And so I think this is a good time for private market in venture capital or technology investments. And if you're super early stage as like, pre-revenue or pre-product market fit, then this is so, the best teams will still be founded today, from the people who have been terminated, the people who have explored new opportunities, from the people who realized that their last company didn't really make sense, but now they wanted to pivot and do something else. I think this will still great teams will still happen. Public technology companies, again, it's cyclical, right? And so the truth is, and I think we may be near the bottom or at the bottom in terms of technology stocks, but it may still take a long time for it to hit the peaks that we saw, because again, 2021 was a function of so much capital liquidity flowing into that piece. So it benefited from both a stock market, bull market, and the allocation from high interest to a low interest rate environment. So that confluence of factors may not come as easily as the next 5 years, for example. So I think the fundamental thing is there's probably really good deals as well on the public markets on tech. But I think, again, you can't do an index, I think, at this point of time, easily.
Okay. It won't be as easy.
Yeah, because, at the start of the pandemic, if you put in $1, you pretty much got to $2 at the end of it, because, there's so much liquidity that the Fed was printing, and then they gave it to everybody, and everybody went on stock market. It went to houses, it went to crypto, and it went to the, tech markets. Like, you look at Zoom, right? Zoom is a tremendous company, and I think he has a lot of strength. and I think it will continue to be a great company for the next decade. It's just that the 2021 price was way above of what the fundamentals actually were in terms of the price to earnings multiples. And everybody knew it. Even the CEO was kind of like, hey, this is a really crazy price. And, but I think people are just like, we have to put this money somewhere.
Yeah, so you're saying that we might not be seeing the all-time highs or even higher for the next 5 years. I mean, of course, it's we don't know how it will play out, right? So it's just giving like, okay, could be a long time frame before you see those numbers again.
Well, if the Fed prints $6 trillion of money in the next 1 year, then definitely put your money in
Fed pivot.
big tech. Yeah, for sure.
Okay. Well, for the rest of us, I mean, you mentioned investing in private markets would be great. For the rest of us who are not into VC yet, right? Myself and Geraldine, right? So how are you managing your portfolio?
I think when you were asking about timing, is it a good time and all that, the same old principles apply, right? Like, don't try to time the market, because none of us here would know, like, when is the bottom. For all we know, tomorrow everything can just like recover and like, and everything, because all these things are out of our hands. So whether it's a good time to invest or not depends on what you invest in, right? So if you do find solid companies, great fundamentals, doing really well and executing really well, then by all means continue to put your money there, because you are basically like getting them at actually a very good price. So yeah, don't time the market, and then stick to the basics, like focus on fundamentals, and make sure that you know what you are investing in.
But you ultimately believe in tech stocks, right? I mean, give it 5 years, 10 years, what have you, like in the long-term perspectives of it.
Well, not all tech companies are made equal. So yeah, at least for the ones that I've put my money in, I do believe.
Number one, what's the best and worst investment they've had? Need not be a financial one.
So my best investment is actually working in tech itself, like choosing to build my career in software as a service. So I think that has been tremendous from all fronts, right? Personal growth, financial, and the kind of things and exposure that I get to at a really like young age. So I really appreciate this opportunity, and my life will be drastically different if I was not in this industry. So that's my best investment. My worst investment...
You're hired, Jeremy is saying. Good answer.
I see the nod of approval.
Nod of approval. Worst investment.
Worst investments... So something I value more than money is actually time. So I think that my worst investments would be investing time into the wrong type of like people, be it from a work perspective or also personal life. Yeah.
Could you tell me a bit more about that?
So for example, like maybe putting a lot of effort to try to coach someone who is not coachable, right? And then that's, to me, it's like I didn't make good use of my time, because that amount of time and effort I could put it into someone else who actually has a growth mindset and a more like ability to the ability and willingness to learn. Yeah.
Because in your job you also coach, mentor and guide people. Okay. Investment of time.
Yeah, and I think there's a lot of truth to, I think the best investment being in the right category, in the right vertical, in the right geography. I mean, my wife always reminds me, it's like you can be the best person in oil and gas, right? And a few years ago, I remember there was a crisis when oil and gas, effectively the price of oil went to zero, right? And it was just, you couldn't save a job, even if you're the best oil and gas, middle manager there, because there's so much pain, right? But now, oil and gas is so expensive, an underperformer, and still,
player,
and you could still be crushing
fine.
it. You'll be fine, right? And so I think technology and SaaS and being in Singapore and Southeast Asia is a really good timing.
Yeah, I feel privileged every day. Okay, so it's like, not. I mean, it sounds like corny, but I feel privileged every day to be working in a high growth sector, in a high growth market, and I feel that like so many people don't have this opportunity, and I'm really lucky to be here.
Okay, so career wise, you gotta pick as well. It affects your career path. Second question for you: what's something that you spend less than $100 that has been a game changer for you?
Treating people. Buying people lunch.
But over the lifetime, I think you've done more than $100.
Okay, thinking from the lunch perspective.
One lunch is less than 100. Okay.
Yeah, I think treating people lunch is something that pays like a lot of return, right? Because in exchange, you actually get a lot of their knowledge and experience, which they share with you during the lunch. You get to build a good relationship with them as well. And you also improve your, what we call luck surface area, right? Because in the future, they might refer you, or you could help them as well. So it's a mutual kind of thing. So I find that buying people lunch is something really underrated. But for me, I've been doing it quite often. When I ask people to meet, I will always tell them I will treat them, and I'll even travel. If you want me to go Pasir Ris to meet them, I also will go. Yeah, correct.
You can also check out Geraldine's previous episode I believe is still relevant, about how to network, how to really build a career. Okay, last question for you. A place that you learn from that you think is underrated. Could be anywhere. Book, website, blog.
So generally, my whole life I've been a reader, so I like to read books, right? And also searching up for things on Google whenever I have questions, right? And all that. But increasingly, what I have found is that I've reached a stage in life whereby a lot of answers cannot be found on Google anymore. And books, sometimes like they may be written by authors who are like living far away and all that, who may not understand the context here. What I found as a valuable place to learn would be actually from people who are actually a few steps ahead of me. So this can be through podcasts when we can dive in depth and then understand their thought processes, the way they make decisions and how they view things. And also through like, lunches, right? Like talking about having lunch with people, because that's where I get to receive like the first-hand, unfiltered opinions, right, from them. Yeah.
Yeah, a lot of books are written from the Western perspective. And of course, Jeremy has a book recently that's for Southeast Asia tech. So if you want to read more about that, you could.
Yeah, we will include the link in the description.
We will? You're telling my marketing people what to do? That's okay.
www.jeremyao.com.
All right. Geraldine, your plug.
That's where you get it.
And now for Geraldine's plug.
So
where to find you?
You can follow me on LinkedIn. And I also recently started to be on Twitter. So I will share my links with you also to put in the description.
All right. Thank you. Follow them. Thank you so much.